Today's episode is going to be our 2025 year in review. It is crazy that it is December. My Christmas stuff is up. The stockings are ready. The elf has arrived. Everything is ready to go. And it is crazy to think that it is the end of 2025 and the end of the year. So we wanted to take this episode to kind of recap everything that happened in 2025, that consisting of rate changes, policy changes, what we did here on the podcast, what we did outside of the podcast. So yeah, it'll be a great episode. And thank you for joining us again. As always, guys, if you're not, please make sure to subscribe and leave us a 5-star review. We do really appreciate it. And if you find what we are sharing with you useful, we would really appreciate sharing it with a friend or family member as well. If you took something away, just helps us grow the podcast, helps us reach and help more people. And yeah, we really appreciate it. Let's start like we normally do, talking about rates, whether it's a recap episode, anything else that we have going on. Let's talk about rate changes that we saw in 2025. We saw 4 rate changes in total. They were a quarter point, but I think we should get our rate guy on to maybe dive a little bit deeper into this. So Cole, take it away.
Yeah. As Austin said, we saw 4 rate changes this year. What I'd like to note here is Austin and I were both wrong. So I have a note from our last year's episode that we both predicted that we'd only have 3 rate cuts. Now, we had 4, which is actually probably a good thing overall. And we saw 2 rate cuts to start the year, and then we've seen 2 rate cuts more so to end the year. So we had a nice long pause in the middle there, which Austin and I have talked about a few times. Is not uncommon. Typically we'll see rate cuts kind of come in bunches, or at least a couple, and then we'll see a pause, kind of like to see what's happening, wait to see how the economy adjusts. And then again, if we need to, we'll have future rate cuts. And that's what we've seen. Now, it is worth noting that we are recording this prior to the last rate announcement. So there is one more rate announcement coming up next week as of recording. It is very unlikely at this point that we're going to see a rate cut next week. I would be absolutely shocked given all of the relevant data has become available now, to my understanding. And
Santa's not bringing a rate cut for us.
Yeah, Santa's not bringing a rate cut this year. He already brought 4, but he's not bringing a December rate cut. So
That's impressive. He did that in January, March, September, and October, but not in December.
Yeah, he liked to spread them out. Anyways, so yeah, we're not likely going to see another rate cut, but that's okay. That's okay. So this isn't a prediction episode, so we're not going to predict rate cuts or anything for next year right now. But yeah, Austin and I were both wrong. So that's not a bad thing. We were wrong in the right way, I would say, in this case. Yeah. And we like to keep ourselves honest. That's why I say that. So anything you want to add here, Austin?
I think what's interesting, we've talked about this on some of the other episodes. Typically, when you see the Bank of Canada start to cut rates, typically that is a cycle. They're not just waking up one morning and being like, let's quarter point, let's do it. Why not? Typically what you see is if they start to cut rates, they will continue to. So that's, I think, why you saw one in January and then one in March. We saw a long pause. There was lots of economic updates, other things that were going on during that, March to September stretch where we saw the next one. After September, we saw another one in October. You're seeing some of the inflation data, some of the things that are coming out recently. I'm kind of hearing the same things. Obviously, Cole's a lot more connected to it than I am. That's more his world. But yeah, I would be pretty stunned if we see another one in December. As far as, is this the last one we see? Do we see more rate cuts coming in 2026? You'll have to tune into our next episode to hear more about that. Let's talk about policy changes as well, because as much as we do stats updates, we do market updates, we talk about rates, all that kind of stuff. I think there's been some pretty substantial policy changes that we've seen this year. Some of that being tax, some of that being other real estate related things. So let's dive into some of the mortgage ones that we've seen, because there's been some changes for borrowers and lenders. Hop into that.
Yeah, so most of these are, not all of these are mortgage related, but let's touch on those ones. So there's been some changes to basically just trying to make it easier to switch lenders. Specifically, if you have an uninsured mortgage, which means you have 20% equity, or you put 20% down when you first purchase the home, making it easier to change lenders at renewal without having to pass the stress test again, because that was a huge deterrent for people. They're like, well, I can't actually qualify at new rates if I want to switch lenders. Maybe I'll just take whatever renewal offer I can get, because for whatever, or not for whatever reason, but I don't have to pass the stress test. They're trying to make it more competitive now, which is good, because it means that pricing has to be sharp if a business wants to keep a customer. So if the bank wants to keep their borrower, then they got to be sharp when they're offering renewal offers, or else they're going to probably jump ship to somewhere else, right? And that's part of my job. My job is to say, look, like, there's some better options here. Here's why you might not want to stay here, and here's why you might want to stay here, and just try to give you all the options that you can when it comes to that. So it's good to have this, because we're going to see a lot more renewals again this year, and we're going to see a lot of people that are stressed to make new payments because their payments are likely going to go up. So we're still going to see that back end of people that put their mortgage in place in 2020, 2021 now, because going to 2026, that's 5 years. That's some of those people are dealing with rates that are still a lot lower than they're going to see today. So it's a good thing. Ultimately, these are the kind of positive policy that we like to see.
Yeah, and I think as much as we talk about rates just on this one, obviously something that we've talked a lot about is, I think for the most part, when people signed up with their mortgage being at those 1.6 or 1.7 or 2%, like those really low rates, I think there was an understanding, we hope, that, that was probably going to be a once in a lifetime opportunity. And we've kind of over the last couple of years seen the repercussions of that. They were obviously stress tested at a rate that would have been higher to make sure that they could afford those payments at that time. But I think the challenge that we're seeing obviously with that is, like, if your mortgage, we've talked about, if your mortgage is $400,000, and which is like the average size, let's say, and your payment goes up by a couple $100, like, that isn't the end of the world, let's say, if you were qualified to be able to afford it. That's part of it. But what we've also seen is, with inflation, the cost of goods, everything else is also more expensive. So how do you factor in mortgage being more expensive, but everything else being more expensive as well? And that's, I think, where people run into trouble. What else do we got here, Cole?
Yeah, very, very good point, Austin. Things are more expensive. The last thing we want to do is make one of your bigger expenses even more expensive.
Yeah, it just all adds up. If your mortgage is a couple $100 more expensive, and then every time you hit the grocery store, you're also spending $100 more, like, all of that kind of adds up. So
100%.
Yeah.
100%. So another thing that we saw is OSFI, which is the Office of the Superintendent of Financial Institutions, or something like that. I might have butchered that, and I apologize. They put some stricter guidelines in place for lenders holding higher leverage loans. Now, this isn't necessarily relevant to a lot of people because they don't really care. But what it means is that the banks that are being governed by OSFI have to be careful how many of these loans they have on their books, or else they can get in trouble, basically. And why that might impact you, but you may not really see the repercussions of it, is it just means there's not going to be as much leniency if you're close to the threshold, and that threshold is about 4.5 times your income amount. So let's say you have $100,000 of income. Based on that, you can qualify $450,000 if your loan to income is 4.5. In some cases, you can push higher than that. And what they're saying is that they're limiting how many loans or how many mortgages they can have on their books that are beyond that. So that just means that, hey, normally I could go to X bank and they would actually be a little bit more lenient because I have other factors that make my application strong. Unfortunately, they have too many of these loans already on the books. Therefore, they're actually going to turn me away, even though otherwise they may have accepted me. That, again, that might not impact you, but there is people that I've worked with directly that could impact them if the lender came back and said, hey, actually, sorry, we can't take on any more loans like this. So not a big thing to the average person, but it's in place because it's trying to make sure that banks and lenders aren't taking on too much risk. Because the last thing we want is financial institutions to fail, because that's when we have huge issues and we have recessions and people lose a lot of money. So it's, again, not a bad thing, but it could impact you if you happen to fall into one of these situations. That's what I'm trying to say.
Very, very well said. On the real estate side of things, what we've also seen are some new home flipping taxes. Some of these were announced in 2024, but put into place in 2025. Obviously, if you're holding a property for less than 2 years, you could incur the tax. There's obviously, and this is the part where I say, please talk to an accountant, please talk to a lawyer. There are some exemptions for certain life events, whether that is a divorce, et cetera, et cetera, et cetera. I don't want to say too much here. But yeah, there are some instances where you can get out of that flipping tax, but just something to be mindful of as well.
Yeah, and just to be clear, I'm 99% certain this is BC.
Mhm.
Yeah, sorry, provincial home flipping tax. Whereas the previous two that I talked about were more at a federal level, just to be clear.
Yes. Yeah. Great point to add. GST rebates for first-time home buyers buying newly built homes. We've even seen some other stuff be announced on this end. There's been some confusion, let's say, among realtors because some of this stuff was proposed and then maybe it hasn't actually went through yet, or they're still working on it. Again, I don't want to. I just want to be mindful of what I say, just because this is kind of some moving goalposts that we've seen. So we'll just leave it at that. And then lastly, for those who do have rentals, which has been a bit of an interesting shift, let's say, there's been some changes at the end of the year here to how rental income is used on a mortgage application. So Cole, this is time for you to tag in here again.
Yeah, for sure. So, I mean, the simple thing to note here is that they're just being stricter about double counting income, essentially, like not using income in more than one place in order to qualify for a mortgage. If you have, and this is going to apply more if you own multiple properties where you have multiple streams of rental income, is just not being able to utilize that rental income from property A to then borrow for property B and property C. So the income that was used from A on B then can't be also used on C. It's going to limit people's borrowing power a little bit now, but with that being said, it goes back to my other point about they're being put in place to protect these institutions so they're not taking on too much risk, because as we've seen, especially in our market, rental income has gone down because the cost of rent has gone down, as well as vacancy rates are also going up as well. And that's because we just don't have as many people looking for rentals, and there's more inventory of rentals. So that can obviously be a problem because now you're not generating that rental income that you claimed on your mortgage application. And are you going to be able to pay that mortgage? So again, it all comes down to risk. That's what these are all based on. It's making sure we protect, the financial institutions. Now, obviously, we're the ones that get impacted by that, but there is an underlying positive approach to this, that they're trying to make sure that bigger problems don't happen. At least that's how I look at it. So yeah, it's been a pretty good year in terms of policy changes. I wouldn't say there's been anything crazy. One that I didn't add on here, Austin, that I'll speak to quickly, is the secondary suite program. The reason I didn't add it on here is because it actually came into place like at the end of last year, or they announced it at the end of last year, so it wasn't technically a 2025 thing. That was another policy thing that kind of happened in the transition between 2024 and 2025. Let's chat about the market in 2025, guys. And then what we're going to do last but not least is we're just going to give you a quick recap of what we've done on the podcast. We're going to talk about some of the guests that we had on, some of the different episodes. And the point here is just to kind of highlight, hey, here's some cool stuff that we've talked about, or some cool people that we've had on. And if this is your first time listening, you have an idea of what to go back and look for. So before we do that, though, let's chat about the 2025 market. I'm going to get Austin to kick things off here about what we saw in terms of how the market played out, I guess.
Yeah, it's been a very, very interesting year market-wise. And I remember one of our first episodes of the year was like Trump tariffs and something else. It was basically the three T's. Yes.
Yep, that's right.
Honestly, the market's been really interesting. It started off fairly strong. We had a good wind at our sales from like January, February, March. And then once we started to feel the kind of effects of some of the tariffs that have been put in place south of the border, I think there's just a lot of uncertainty that we've seen.
Mm-hmm.
Combining that with some of the other changes that we've recapped that have all taken place, I think there's just a lot of uncertainty, and people typically, when they have uncertainty, they are afraid to make decisions. So a lot of people are just waiting to see how that all plays out, which is really interesting. Obviously, over the last couple months, we've seen prices come down a little bit. And we've seen them basically since, like I'm looking at the Fraser Valley Stats Center here, and basically from April we've seen a small or a subtle slight decrease continually over since then. I think that's a combination of lots of listings, uncertainty, and some of the things that we've seen implemented. So yeah, it's been interesting. Where do we see things going in 2026? Again, you'll have to stay tuned for that. That's our next episode. But yeah, what was your experience in the market? Because typically what is common for people to say is, oh, well, as rates come down, you'll see prices go up because things get more affordable. We've seen that. And
we've seen the rates go down.
Yeah,
we've seen that part of it.
We've seen the rates come down part of it, but we haven't necessarily seen the prices go up accordingly. And when we see prices at where they are at, and then rates in a favorable position, we talk about all the time, it might make a lot of sense for you to make a move right now. But what are your thoughts?
Yeah, no, I think ultimately we still have an inventory problem. And I think goes without saying. I think until that problem can be corrected, we're going to continue to see the market remain either balanced or more so in a buyer's market. But yeah, I'd say from my perspective, I guess 2025 market, there's good opportunities for people that already owned a home to refinance their mortgage. And why I say that is depending on when they put their mortgage in place, which is very possible that they did, say last year when rates were higher, there's some opportunities to get out of those mortgages, even if they had to pay a penalty to do so, and save quite a bit of money. So there was a lot of refinance opportunities, I would say, just speaking personally, as well as speaking to colleagues and other people in the industry, excuse me. And then beyond that, like Austin said, there wasn't a booming market for buyers, but there were still lots of deals to be had. So it's nice to help those buyers. And I know Austin and I can both speak to that. Find a place at what we thought was very good value, and get into something that maybe they otherwise couldn't have a year or two ago because it was just unaffordable. Quite frankly, they weren't able to do it. So I think there's a lot of good things about that. Now, if you were looking to sell your home in 2025 and you weren't also looking to buy, maybe that wasn't the best for you, right? And maybe you weren't able to get top dollar compared to what you were used to be able to get. Excuse me. Yeah, it's tough. you're never going to please everybody, I think, in any market, Austin. If we look back to the years where prices were super high, that's great if you're selling, but if you're just looking to buy, you're probably going to get hit pretty hard because you're going to be paying top dollar now to get into the market. So you can never please anybody. I think something that you said more on one of the more recent episodes is ideally we have a balanced market. That's preferred for everybody. You're not necessarily going to please everybody in a balanced market, but it's more predictable. It's easier for people to kind of know, okay, this is roughly what I can sell for. This is what I can buy for. There's going to be competition on some places depending on the place, but in a general sense, there's more of a consistency to how things play out. And I'd say that's something maybe doesn't matter as much to me, but to Austin probably is a more favorable environment to be working in, especially with clients. Yeah, I don't know. Do you want to speak to that a little bit, Austin?
Yeah, it's funny. As you've been talking about this, I've been looking at my friend, the Stat Center with the Fraser Valley Real Estate Board.
Yeah.
Over the last 2 months, basically, when I look at active listings, at the peak, they were at 8,908 in May. Those came down slightly. Then we saw, September 8,723 for, active listings. And since then, they've come down over 1,100. So in November, we were sitting at 7,660 for active listings in the whole Fraser Valley, which is, still a lot, still higher than what we've seen at the peaks of other years. And this is kind of the valley, it's part of the valley of this year. Basically, we're sitting at the same as it was in March. When I look at sales to active ratio, So like percentage of homes that are selling. November, we had 11.6% sales ratio, which is like just a hair under a balanced market. Typically 12 to 20 is what we consider balanced. So like, 12 and 100 or 1 and 5 basically, which would be 20. Doing some math on the fly there. Don't worry about it for everyone playing along at home. So again, that's what we would consider like a balanced market. Anything more than that 20%, we would consider a seller's market. But yeah, I mean, at the peak of this year, we were sitting at around like 12.7, 12.8 in October. And then at the Valley, we were still sitting around like 10.1, 10.3%, which is like 1 in 10 homes basically. So yeah, balance would be great if we can get up to like, let's say 13, 14, 15%. That would be amazing. But where we're at here, there's still a ton of options for people getting into the market. I've helped quite a few first-time home buyers this year navigate and get into their first place, which is awesome. Definitely for some people, it makes a lot of sense to transact right now. You're seeing prices that have shifted. You're seeing rates that are in a good spot, favorable spot. People like you talked about 2-3 years ago would have loved these rates. So now we're in a good spot for that. So yeah, it'll be interesting for 2026. And again, no teasers.
Not yet.
Yeah. Do you have anything to add on market from what you've seen 2025? Obviously you talked about rates, but
Yeah, no, I don't think so. I think that the biggest thing for me is there was definitely opportunity there. The thing I'm, I guess, most proud of for 2025 is being able to help people save money, because that's honestly what I like the most. I want to help you buy your first home, but it's even cooler in some ways to help somebody that you've helped before and then be like, look, I have this new opportunity for you to save you money. Here's how much money you can save. Here's how much extra money you can keep in your pocket. I think that's the most valuable one, because Austin spoke to the fact that maybe your payment goes up $200 because you're renewing in 2026. What if I can make your payment go down a couple $100? Like, you're going to love me for that. So,
yeah. Do you know anything you can do with a couple $100 a month that you're
right?
aware
Like,
of?
yeah, exactly. And I'm not trying to put you in a worse position by making your loan an infinite loan that you're never going to pay off. That's not what we're talking about here. We're talking about getting you a better rate, in the process often being able to consolidate some higher interest debt as well. And on top of that, in many cases, saving you money month to month. Like, I know it sounds too good to be true, but depending on where your rate was compared to where it is now, those opportunities are there. And those are probably the most valuable thing to me, is being able to help people that way. Because you get to see the full circle of like helping a family buy a home, get into that home, and then years later you help them save even more money by then refinancing that mortgage. Those are the best. Those are the places, or those are the times when you can really feel like you help somebody. So that was really rewarding for me this year. And those opportunities still exist. Like, there's lots of people out there that are paying a much higher interest rate than they should be, because they don't, number one, they don't know that they can do better, or number two, they're too scared to break their mortgage because like, oh, it's going to cost me money. Okay, but what if we add that money into the mortgage and then we still save you money overall? Like, yes, it's going to cost you X amount to break that mortgage, but you're going to pay Y amount in interest by keeping the mortgage. X is going to be lower than Y. Why don't we just pay that money now, add it to the mortgage, which means you don't actually pay it now, and then ultimately save you money down the road. Anyways, I could talk about this all day, because it's something that I see a lot of value in, and a place where I really enjoy helping people is saving them money. So, without further ado, though, Austin, let's jump into a quick recap of this year in terms of our episodes. So we can do this one of two ways, Austin. We can either go into some of the awesome guests that we had first, or we can talk about some of the episodes that we've done. There's some repeat episodes in the sense that we've had some similar themes like stats. Which one would you rather do, guests or just more of the
let's do guests first. And you guys might be sitting here saying like, Austin, Cole, it's December 1st that we're recording this, and it's going to get posted today. Why are you talking about end of year recap? There's still a month left. We've got a pretty substantial episode coming up next, which we're really excited about. We have another couple episodes banked that we've recorded that we can't post quite yet. Yeah, we wanted to get this in. Obviously, we have our 2026 prediction. We are hoping to take some time away from recording over Christmas. We're going to spend some time with our families, which seems like a good idea at Christmas. Yeah, we got some really excited things that will be coming before the end of the year. So stay tuned for that. As far as guests, yeah, we've had some really great conversations. As much as we like, let's say, interviewing or having people on the podcast to talk about things that we find interesting, we also learn a lot from these people. So a big shout out to Richard Baxter, who we had on at the beginning of the year, talking about fitness and health, getting everybody into the wellness mind frame at the beginning of the year. Roman St. Germain talking politics and everything up his alley that he follows along. So a big thanks to Roman. And then as well on the realtor side, Braden Reimer, Alex Dunbar, Ty Corsi, and then Jeremy Kalanick, just some really awesome perspectives. We've had them on to interview as well as part of our agent expert series. Learned a ton from them. I know from chatting with others as well. People had some really great feedback about those episodes, which is awesome to hear. And then we had some pretty kick-ass mortgage brokers on as well. And I'll let Cole talk about that.
Yeah, we had Ryan Oak, who is our first ever mortgage broker guest, I think.
Yes.
Now that I think about it. And then we had Dean Lawton, who is a mortgage broker, but more importantly, he's a mortgage owner. He owns a business where he employs a lot of mortgage brokers. And that's really what he excels at. So it was really cool to have him on and have a different perspective on mortgage brokering and how he runs his business, and just learning from all these people. So if you haven't checked it out yet, we did a bit of an expert series. So far, we've had 4 people on the expert series. Then some of those were the people we just mentioned.
But we're hoping best one's coming next. Stay tuned.
Yeah, absolutely. There's more to come, and we're hoping to do more as well. So I guess this is a bit of a shout out. If you think you're somebody that would be a good guest for something like this, we're always open to that. Or if you know somebody, you're like, you guys really need to talk to this person, please shoot us a message. We're more than happy to consider that. So that's, I guess, a little bit of a tease for 2026, is we are hoping to do more expert series. We will obviously have more guests on whenever we can. That's something that I think I speak for Austin and myself when we say that those are probably our favorite episodes to do is talking with other people and learning from them. So
yeah, because we just can't stand each other.
Yeah, we only do this because we don't like each other. So anyways,
sorry, that was right there.
No, it was too easy.
Yeah. But yeah, and with that too, I think one thing I think about as we are just about to hit 100 episodes.
Yeah, crazy.
I think of some of the other guests that we've had on the year before that had like nothing to do with real estate, whether that be Brody, yeah, talking about brain injuries, kinesiology, biomechanics, all of that stuff. That was an amazing episode. And then some of the other ones we've had. Managing brokers on. We had Adam with AFK Media on talking about kind of that space. Yeah, some really great conversations with people. And yeah, I'm sure that we will get into a more diverse topic or a diverse group of guests in 2026. So yeah, let's talk about as well some of the episodes that we've done this year. So yeah, some really fun episodes like debunking real estate myths.
Yeah, that was good.
Some more functional ones, and like, hey, if you're thinking of moving, what are the things that you're weighing when you do that? Do you want to move a little bit farther out so you can get more house, or does location is super important to you? So some of the trade-offs, that was a really great conversation. How much does it cost to move? Which was a great one as well. Talking about, hey, you sell or you buy, what are all the other fees that you can expect to go into that? Some functional ones too of like, hey, if this is your household income of like 150 grand, what does that look like of what you can actually purchase in different areas? A lot of episodes on first-time home buyers as well. So some tips, some tricks, the first-time home buyer seminar that we ran. And then last but not least, of course, some stats and market updates. So all of those, if any of the things that we just listed pique your interest, go back through the feeds because we've had those topics of episodes, and feel free to check those out. Yeah. Cole, do you have anything to add?
No, that's pretty much it. I mean, there's like a few other, like, we'll speak to policy changes when policy changes come out. as Austin said, stats and market updates. Those are ones that we're going to do every month, so you can bank on those. But yeah, we're trying to have fun with some of these other episodes because we like to have a mix of, okay, what's happening in the market? What are some cool people that we've talked to, as well as here's some other things that we think are relevant, and trying to create, I guess, a situation of like, here's the position we're in. For example, like we have this much income. What does this actually get you? Or, hey, you know what? We can move further out, as Austin said, but here's some trade-offs, like things like that are actually practical to our market. Like people are having to have these conversations, or having to think these things over, because it's the reality of it. Like we're still in an expensive market. We're not we're not unaware of that. We're very, very much so aware of that. But it's nice to look at different approaches to things, and different ways that that some of this information can be valuable to you guys. So again, if you have anything you're interested in, please, we're always open to different ideas. We're going to continue to brainstorm ideas and bring different episodes next year. Yeah, so again, we're not going to hint at anything coming in the new year, but we're planning to grow for sure. We're planning to try to bring this podcast to you in I guess is a little bit of a tease, Austin, in more ways than just the ways that we are now. So
Yeah, and I think if we're keeping ourselves honest here, one thing I think about with this year is obviously we had to take a bit of a break. I think we've been in a really good rhythm since then, of back being, basically a weekly episode. Typically, we're dropping these episodes on Monday in the morning. I think one of the challenges that we had, and we'll talk about this in our 100th episode, I'm sure, was just the logistics of lining multiple schedules up, multiple people up to record in person. And we've found a very effective way to record virtually now, which makes a big difference. As much as it's nice to sit down with guests in person, and that's a great experience. Logistically, that can be challenging. Technology with that can definitely be challenging. And I can assure that by being the guy that kind of ends up having to do the tech and the back end stuff.
Yes, head of IT, Austin Catalano.
Yes, I'm wearing a lot of different hats, and a lot of them involve editing. But anyway, I think we've got a really good rhythm and a really good quality product. Obviously, we've learned a ton from 99 episodes that we've recorded. And we think we have a really good system dialed in right now, but of course we're always looking to evolve and make that better, and we'll continue to do that. So yeah, thank you for joining us for another episode, guys. We really do appreciate it. If you liked our episode, make sure to leave us a 5-star review and subscribe. That helps us a ton. And feel free to share it with a friend or family member. It goes a long way for us. And again, we really do appreciate it. Adios.